and welcome to this week's GoNoGo show here on StockCharts TV. My name is Tyler Wood, and I am joined by Alex Cole here on April 20th. How are you, sir?
I'm very well, thanks. How are you?
Yeah, gearing up for the largest global investment conference the CMT Association has ever held. Next week is going to be a riot of sorts, the Coachella of charts, the festival of volatility. We'll see what happens, but we've got a lot of special guests and really looking forward to seeing old friends and meeting some new ones in New York City next week.
Absolutely.
Yeah, I know the entire StockCharts team is coming out. Looking forward to seeing David Keller and a live episode of The Final Bar filmed at the 50th anniversary. But Alex, before we get to all of the celebrations of the legends of technical analysis, why don't we check in on today's markets? Let's start, as we always do, with that top-down perspective, starting from our cross-asset heat map, just to get a sense of what's happening between intermarket forces and how we might see that impacting the equity space.
Yeah, absolutely. And there's really not been a lot of change, Tyler. The equity top panel, even though we've pulled back the last couple of days a little bit, you can see how we're in those strong blue go bars. That's, of course, the top panel. So a go trend in equities. You can see TLT, which are Treasury bond prices, flirting between the aqua and the amber bars. Commodities managing to hold on to their go trend as well, and the dollar still in a no-go, although those bars are painting the weaker pink color now, as we see for the last couple of days.
Now, as we know, correlations are not constant, right? There are historical corollaries that we can look at to markets like this, where a falling yield, a weaker US dollar can be stronger for equities and risk assets broadly. But as we saw in 2022, sometimes those correlations move to one. And so we keep an eye on some of this cross-asset work just to get an understanding of the shape and the tenor of the markets. Again, we're using GoNoGo charts to just pull our eye away from all that price activity and consider the trend alone. So when we're looking at these blue and aqua bars, that means it's in a go trend, an upward trend. When we're seeing pink and purple bars, that's our no-go variety. We have a strong and weak form for both. And then the amber bars are when all of the component pieces, all those blended technical indicators in the background are in their neutral level. And as Jesse Livermore is famously quoted as saying, there's a time to go long, a time to go short, and a time to go fishing. So those are our go fish bars. Alex, let's jump off of this cross-asset map and let's just take a look at the TNX, the 10-year Treasury yield. And what I think a lot of investors have been preparing for was higher for longer. And we certainly have some great macro analysts coming to the conference next week. I was able to sit with Urian Timmer and Jim Bianco at the Game Forum in New York a few weeks ago. Alex, what are we seeing from a trend perspective in terms of sovereign bond yields?
Yeah, well, we haven't seen that higher for longer rising environment. What we're seeing is perhaps a sort of a sideways move, or perhaps we're coming to terms with where rates are, and it's not just a non-stop move higher. We're seeing that at the moment on the daily chart here, we're actually still painting no-go bars, and you can see that we tested these prior highs and we've come back lower today. So we have rallied strongly from the low that we put in just about 2 weeks ago. And the oscillator of concern is above the zero line. So the oscillator is in positive territory, but the weight of the evidence suggests still a no-go at the moment on a daily chart. So not runaway rising rates for the moment.
You know, as we were talking yesterday in our presentation at the Wealth 365 conference, had some really interesting questions from that audience about the interplay between price action and the momentum oscillator, the go-no-go oscillator in that lower panel. So Alex, for your eye, when we're seeing a no-go trend and we see positive momentum, that's a clear sign of difficult times ahead for that trend to continue, perhaps a leading indicator of reversal. Is that correct?
Yeah, absolutely. It is the first sign that we're going to get that the trend that's currently in place is in trouble. But of course, the trend itself is going to be the primary consideration. And so the weight of the evidence does still point to a weak form no-go trend, but the fact that the oscillator is in positive territory is the first sign that this trend is in trouble. If we were in a healthy no-go trend moving lower, comfortably, then we wouldn't expect any amount of overbought readings to be pushing this oscillator into positive territory, we would expect the zero line to act as resistance. So yes, the trend says we're still in a no-go, and it is weak, but we're still in a no-go. But this positive momentum that we're seeing from the oscillator, especially as you can see, it came after bullish divergence, certainly a signal of some struggle for the trend.
Yeah, exactly. Divergent signals between momentum and trend often characterize a little bit of that uncertainty. Alex, if you could take this same chart and just bounce it out to a monthly view so we could take a really long-term look. A lot of consolidation here at these current levels. Certainly not blasting off higher, but well above the 40-year downward sloping trend line that gave us that secular understanding of what a falling interest rate environment has looked like through our entire lives.
Yeah, and I actually bumped it out to a quarterly chart just now, Tyler, and you can really see that multi-decade long downward trend that showed those falling rates really since the mid-'80s or even early '80s. And you can see that we have that structural change. We've moved above what would be downward sloping resistance. We've painted several go-colored bars after those true transitionary amber bars, oscillators in positive territory. So if we really are thinking long-term, then these rising rates are perhaps here to stay. But in the very short term, they aren't running away from us just yet.
Absolutely. Multiple time frame perspectives are always critical to getting a clear view in our analysis. Thanks for that, Alex. Let's move on from Treasury yields. Let's take a look at the US dollar. Here at GoNoGo Charts, we use a lot of ETFs as proxies. So for the dollar index, we're looking at UUP is the ticker symbol. That way, we're able to see some volume activity on the dollar index as well. I'm seeing a no-go trend in its weaker form as we ride the zero line from below. Let's talk a little bit about the squeeze, Alex.
It's quite a similar chart to what we were just looking at with the TNX, with the exception that the oscillator has not broken above that resistance just yet. We're seeing the oscillator stuck at the zero line, and that's causing the climbing grid of the GoNoGo squeeze indicator to rise. So what that tells us is that we've got reduced volatility here as price movements decrease in their sort of velocity. So we're seeing a bit of a directionalist move in terms of momentum. Now, that doesn't mean a loss of interest. We could have quite active trading going on here, but a bit of a tug of war between buyers and sellers. Now, we are still seeing the same kind of bullish divergence. We've had lower lows in price, higher lows in the oscillator as it comes up to test the zero line. So very, very important inflection point. If we see this hold as resistance and turn over, then that could well make price retreat lower to test these prior lows.
Absolutely. As we've talked about in other seminars about embracing volatility, what we were referring to is the idea that volatility compression can be a really important signal for both trend continuation or trend reversal. And that trading in the direction of a break, as we learned from Keltner bands and Bollinger bands, can be a really powerful way to capture high velocity moves. So where we have these volatility squeezes, where momentum is riding the zero line, where there is no decisive positive or negative momentum, that's the tug of war between buyers and sellers. And after all, technical analysis is really the way of visualizing data of the markets to help understand investor behavior. And when that tug of war ends and everybody pulls over to one side or the other of the trade, that's what creates that herd and a strong move in that direction. So we're watching this inflection point on the US dollar. As you said, like Treasuries, not moving decisively lower, a lot of consolidation happening here. So let's move away from the US dollar. Let's check in on gold. One of the shiniest objects in our portfolio, perhaps.
Literally.
Literally. Alex, talk to us a little bit about what we're seeing in gold on this daily chart, and then we'll look at the very long-term view as well.
Yeah, I mean, the daily chart is a fairly good looking go trend. We have seen some weakness this week. The past 5 days or so shows us that we're painting aqua bars. Those are weaker bars as we came away from that high. Extra points for anybody that knows what that candle formation would be there with the doji gapped higher and then, of course, gap lower as well. That's an interesting short-term bearish signal. But, of course, candlesticks fairly short-term, so we see that retreat there from the high. Bearish divergence as well, though, from the oscillator. Price making higher highs, oscillator making lower highs as we now come back to test the zero line from above this time. And you can see that grid of the go-no-go squeeze rising as we see a similar tug of war on gold as well. So all else being equal, we'd expect the zero line to hold. And if we find support here, then perhaps price will make an attack to go higher.
Absolutely. I'm starting to catch on to a theme here, Alex. We've got some stagnation, some volatility compression, and maybe a little bit of an uncertainty around which direction these trends are headed. Talking with our good friend Jay Woods from the floor of the New York Stock Exchange, got 20% of the S&P 500 reporting earnings, and it's frankly quite quiet. So perhaps all the portfolio managers are cleaning up their garden beds and doing some spring household work as opposed to minding their portfolios. But let's keep moving through our intermarket forces. Let's take a look at U.S. oil. Wow. I'm going to
pull this up on a weekly chart. This is the chart that we've been following, Tyler, and this is where we want to make the point that even though we look at the whole picture, the trend remains the most important skill that we can, or trend identification, remains the most important skill, because we saw this break in the oscillator, break above the zero line, very, very important. First time it had happened in just about a year, as the price tested this downward sloping trend line. Now, we haven't got out of the no-go trend, though. These bars are still painting pink, and today clearly not a good day for oil. So we'll want to see now, will this downward sloping trend line act as some sort of support, depending on where we close, at the end of the week, or does this take us back into that downward trend that we were in? So like you said, all these charts really showing us uncertainty, and certainly a lot of inflection points everywhere where we'll really need to watch to see which direction these trends take.
Absolutely. Sometimes breakouts can be fake outs, and that break above a downward sloping trend line, still in no-go conditions, meant that we didn't quite have enough in terms of the weight of the evidence to give us a signal from the composite blend of indicators. But as you say, the Bible of technical analysis, written by Edwards and McGee in the 1930s, sometimes just understanding basic pattern recognition and understanding what these price levels mean can really help us as investors. So fascinating look at oil as it's retreating from that strong rally just last week. Alex, let's move on and let's take a look at our crypto rel map. Now, we're big fans of referring to 5 asset classes here at GoNoGo Charts: bonds, stocks, commodities, currencies, and also digital assets. We've been looking at this the last few weeks, both in terms of an absolute trend, but also the relative strength of cryptocurrencies against a basket of equities like the S&P 500. Here we're looking at the relative ratio of each of the 4 largest by market cap cryptocurrencies against the performance of the S&P 500. This chart is showing us that Bitcoin, Ethereum, Cardano, and Ripple are all steadily outperforming the S&P 500. Is that correct, Alex?
That's absolutely right. The only thing I'd add to that is that we have seen some weakness come into the GoNoGo trend indicator. This is Bitcoin in the price panel. So we see that pullback from highs. This, of course, is a counter trend correction arrow telling us that in the short term, price may struggle to go higher, which is exactly what's happened here. And you can see that even on a relative basis, all of these cryptocurrencies relative to the S&P have weakened in their relative outperformance. They're painting aqua bars here on the right side of the chart, but all 4 of them still outperforming the S&P on a relative basis.
Absolutely. All right, let's get back to the equity space, and let's get under the hood, taking a look at the sectors and their relative performance to the S&P. So the same idea here is what we looked at with that crypto rel map. We're going to use a GoNoGo rel map of all sectors of the S&P 500 against the benchmark index. And what we have seen for weeks is a bifurcated market, a split or a barbell, so to speak, which characterizes a sort of difficult environment for a lot of asset allocators. We're seeing growth equities, the information technology and the communication sector outperforming a rising S&P 500. But we've also seen our most defensive sectors, healthcare, consumer staples, and utilities, in a rising go trend relative to the S&P. So that those two barbells or bookends are basically avoiding everything in the cyclical sectors, where we're seeing industrials, energy, financials, and materials underperform the benchmark. And remember, those were our leadership groups through the bear market. And right now we're sort of split stylistically on what is working. Yeah. So Alex, talk to us a little bit about what we're seeing from the strongest performing sector, the XLK, the information technology sector. Why don't we pull up a chart of the XLK just on an absolute trend basis so we can see how that's performing from a price action perspective as well.
Absolutely. And we can debate all we want. You know, people are always sort of saying we'd like to see more leadership within the sectors. It is unusual to see, as you said, these two seemingly opposite strategies playing out so well. You've got the growth sectors outperforming as well as the defensive sectors. So very, very interesting moment as we're seeing on all these charts. But here's the technology sector. You can see that we've made two clear higher highs. We're painting strong blue go bars. We've just found support at the oscillator at 0, which has given us this go trend continuation icon. And now we're quickly back to test it again. So again, another squeeze, Tyler, you know, in its early stages, but rising close to its max. So even here, even with this strong outperformance, we are seeing a little bit of a tug and war within the buyers and sellers of technology as well.
Absolutely. And within that technology sector, as we often do here on the GoNoGo show, we want to dive into the industry groups that are working within that sector. So we continue to use our relative strength methodology, right, from the asset class perspective down into the sector groups. We find the sector groups that are working, then we're going to dig into the industry subgroups that are working within those sectors. So within the information technology sector, we see some leadership in the top two panels and that fourth one. Yeah, that's the semiconductors group, if I'm not mistaken.
No, this one's hardware. So this is interesting because we've been talking about semiconductors for a while here. That's the third panel, and I believe I don't want to misspeak, but I'm pretty sure that one is. I've been looking at it for weeks. Yeah, that is semiconductors, and semiconductors has rolled over now, which is interesting because we've been looking at things like NVIDIA and others for a while. This is computer hardware, but that makes sense too if you think about some of the companies that are doing well on an individual stock basis. I think the top one, if you remember, was renewable energy, which we were joking about, you know, as technology sector having a renewable energy subgroup. But this is the one now that's in a strong outperformance, is the computer hardware.
Absolutely. Quick note to all of our viewers, when we're looking at these relative charts, right, when you're seeing pink and purples on a ratio of the subgroup to the sector, or the sector to the S&P, or an individual security to its sector, that doesn't mean that it's in an absolute downtrend. Right. What it means is that relative to an outperforming XLK, it is not leading, it is lagging. Correct. So that's what we're seeing from semiconductors. That's not this shouldn't be mistaken as a cue to sell out of all of your positions in semiconductors. But when we think about relative strength investing, we want to allocate capital to the things that are working and leading the market higher. So we want to find those sector groups that are leading, and then find the industry subgroups within that are bringing those sectors higher. Alex, let's turn our eye to the healthcare sector. Yeah. And why don't we just pull up XLV for a moment on its own? Because as we came into 2023, the healthcare sector was actually a great shorting opportunity, right? Yeah. Where the S&P 500 began to rally, we saw a lot of the defensive sectors roll over, and then roll over hard. That has the flight path of a brick, if I'm not mistaken. Yeah.
And look at these continued trend continuation icons to the downside. That's what these red circles are telling us, that once this no-go trend took hold, we continue to get confirmation of that, with momentum staying in negative territory all the way until we hit down here in these lows. But as you said, now we're seeing some relative outperformance and the go trend in place on the healthcare sector itself. Of course, there's quite a lot of congestion to get through at these levels. As you can see, we came away from a counter trend correction arrow. We've pulled back, and now we're asking for support at the 0 line. So we're looking at the oscillator to see if it can hold the 0 line as support to perhaps allow this trend to continue.
Absolutely. A lot of holders at these prices, a lot of overhead supply, and that's the behavioral component that we're talking about. When we look at concepts like polarity, what had been resistance as the XLV, the healthcare sector, tried to break back above in late December, trying to hold on to those last innings of the Go trend. That was our resistance area, and we are right back there now, looking for support in this current Go trend. So Alex, let's do the same exercise. Let's dive into the industry subgroups within the XLV, the healthcare sector of the S&P 500. Let's take a look at what is outperforming right now.
Yeah, and there you go. It's really the top panel, medical supplies, that has been able to stay in this Go trend on a relative basis, as you said. Great clarification there earlier that any one of these could be in a Go trend on a pure trend basis, but relative to the outperforming healthcare sector, we're really seeing that it's these top two panels now, but it's medical supplies, the top panel, that's consistently outperformed throughout this time period.
Absolutely. So that's DJUSMS is our ticker symbol for the medical supplies industry subgroup of the healthcare sector. Alex, let's dive a little deeper. Within the medical supplies space, let's pull up a chart of XRAY. And this came out to our institutional subscribers on Monday in GoNoGo Flight Path. That's the weekly newsletter that comes out pre-market every Monday morning. Look at that absolute Go trend.
Yeah. I mean, XRAY came across, and it's an interesting one to look at, because when we sent this idea out earlier on in the week, it had just broken above this level that had been resistance. If you see these two prior highs here, Tyler, we were kind of running up against that for 5 or 6 days in a row and struggling to break through. And then we did. So this is what we were talking about earlier on in the week, how we were now going to hope to see consolidation above these levels. And we are right there. So we're looking to find support at this level. If the oscillator gets back to zero, then we'll look for support to see if that holds, and we'll to see if this trend can continue to move higher and set new highs. And the other thing that's exciting about this one, Tyler, if we back it out to a weekly chart, we get the sense that this could be perhaps early days. Remember, we're always sort of thinking, oh, is this already done? Is this move over? Is it over? Have we missed it? Well, if we back it out to the weekly, this could be something that has legs. There's not a lot of resistance up until we get to these levels, but you can see the size of this no-go trend really brought prices lower. We're just now back above zero, break out of this max go no-go squeeze. We've then subsequently retested the zero level, found support, trend continuation icon, and we're getting strong blue go bars. So a really positive looking weekly chart.
That's 5 quarters of a base, right? So the bigger the base, the higher in space, as Luis Yamato taught all of us.
Buy the smile.
Yeah, buy the smile. We don't like frowny faces, right? We got to keep it simple. But that's a longer term look at a long basing pattern, which is why we would make the comment that this could have a lot further upside potential. It's human nature, right? That we see something that's been in an uptrend for a couple of weeks and figure we've missed it. And that's often not the case for trend followers. Alex, this has been a pleasure. Let's finish off our show today. Let's take a look at Freeport-McMoRan, the mining company, and then we're going to take a look at Eli Lilly. And you've got this on the weekly basis. Let's take a look at this on a daily. Right, so we are catching some support, looking for support, I should say, as the oscillator comes back to test the zero line. Yeah. And the reason to pull up this chart is that it really highlights the go-no-go squeeze, and that it can be used in both a trend continuation context or a reversal context. So over there in the on the left side, in that middle of that go trend around mid-December last year, we saw a max squeeze build as price consolidated, right? We had strong gains, market needed to digest. We're in the weaker form of the go trend, meaning the veracity of the move had weakened, and we saw price activity, the range of price action really narrow. That's our tug of war. And when we see this decisive break, what was really a max squeeze broken into 3 small grids, a max squeeze break to the upside, and then we saw volume come in to participate. That's where we see that very strong high volatility move out of the break. Now we're seeing, so that's the trend continuation context. Here over on the right side of the chart, we see a trend reversal where the exact same case. We're in a no-go trend. We're in negative territory in the GoNoGo oscillator, negative momentum. We come up to test the zero line and ride the zero line. It's when we see that decisive break above zero and the retest that we can establish the new go trend. So that interplay between momentum and price activity, price trends, is really critically important. And we want to have a complete composite view of all technical analysis in one chart that keeps it clean so we can keep our eye on the price action. So Alex, from this perspective, we're back at testing zero. We've fallen off in that new go trend, coming back to test that downward sloping trend line. What would you be looking for next?
Support at zero. You said it all. We'd be looking for support here at zero. That might well line up with support at this downward sloping trend line that was resistance and now perhaps could be support. So we'd be looking for the oscillator to hold the zero line. If it rallies back into positive territory, we'll get a continuation icon, and then we'd look for new highs in price.
Yep. We're seeing some constructive evidence in home builders, copper, industrial metals. So lots to look forward to this summer and through the rest of 2023. Just before we leave here, Alex, let's pull up a quick chart of Eli Lilly, LLY.
There's an interesting tick happened here in the middle of the chart, but another healthcare company, and you can see the strength of that trend. You can see how the GoNoGo trend entered no-go territory, moved lower, succession of lower lows and lower highs as the oscillator stayed primarily below the zero line. Well, we crossed over that zero line on heavy volume. You see that dark blue on the oscillator here. And now, of course, we're in a strong go trend, very strong momentum as well. And we're looking to see if we can close above these levels that were resistance earlier in the chart.
Absolutely. Alex, as always, it is such a pleasure to talk markets with you. I'm looking forward to doing it in person next week at the CMT Association's 50th anniversary symposium in New York City. For all of you watching the GoNoGo show, we'll have an educational episode for you preloaded, but we'll see you back here for live market coverage in 2 weeks' time. Thank you so much. Take care.